other parameters as well, like lending curves and quite an assortment. I think it might be a good idea to expand the scope of these calls to include those conversations. And the reason I started thinking this is we recently had a change in the rewards provided to the AMM, specifically the sovereign dollar BTC pool. And the conversations around changes like this have been managed by the Circle of Tokens, primarily over the forum, although more recently I think they've been less easily accessible. And I think by introducing conversations of that kind to these calls, we can have a more consistent, more transparent, and more public conversation around topics like this. Additionally, what we can try and do is create a forum thread before rather than after these calls, so that people can suggest topics of conversation, which parameters they would like to focus on, as well as potentially specific changes that they would propose, and that can ground and provide structure for these conversations. With that said, we will today continue with the conversation around the sovereign dollar and zero. And so first, looking at sovereign dollar stats, I'd like to look at primarily the 15-minute and daily peg. So what we're seeing is a overall improvement, certainly from March and April, but into June we've seen the peg to the downside maintain much more robustly, and over the last 2 weeks we've seen a fairly tight peg within 2%. There is still room for improvement here, and I think that warrants a conversation around further reduction of the redemption fee to 0.5%. And I'll come back to that topic. If there are other points here that people would like to focus on, just shout it out, and we can take a look at that. Moving on to the zero analytics. One digit, would you mind providing the public links to these dashboards? It's more difficult for me to do it while I'm looking at the screen. All right, so coming back to the zero analytics dashboard, we have a 5% origination fee and a 1% redemption fee. And the way this has been playing out is we've been seeing both a moderate reduction over time, but culminating in terms of open lines of credit. In terms of BTC collateral, it's mostly flat, and in part that's due to the increase in the total collateral ratio to above 300%. And in terms of ZUSD outstanding supply, we've also seen a reduction. The last week is interesting. Looking at the last week of activity, we've seen primarily originations, although the week before we saw primarily redemptions. And in terms of redemptions, you can see that there was a gap, and it's spiky, with an overall trend which perhaps could be said to be a reduction in overall redemptions, although again not clear. And that is despite the fact that we had reduced the redemption fee, which you would expect would see an increase in redemptions, and I don't think that we've observed that. In terms of the ZUSD and the stability pool, I think this remains something where we can better communicate it and also provide better gateways. I think this is going to require a number of efforts, better bridging and better communications, a better UI showing what the true returns are. Although, of course, this is a fairly sophisticated system with spiky returns, so that's not super easy. And so that's where we are right now. We continue to see originations. There seems to be over the last 2 weeks more or less a balance of redemption and originations. And I think this chart over here is particularly interesting, and there might be a better way that we could display it. Actually, one digit, is there somewhere where we could... Oh, I think here we have sort of like borrows versus repayments, right? So people repaying the lines of credit versus liquidations versus redemptions over the last 7 days. And this is relative to the supply. If we start that...
Yeah, just put that date in there like a month ago or something, and then
Sure.
It'll zoom in.
So if we take this to the 20th of May, which would give us a month, that didn't seem to work. Oh, there we go. It's the wrong year. Okay, so looking here, there haven't been redemptions of the liquidations over the course of this month. In terms of borrow versus redemptions and repayments, we see that repayments are actually the primary source of we see that until just very recently, and I don't know how significant this is. There were more redemptions than repayments, and there was over the course of this month, the system was weighted towards the aggregate of redemptions and repayments versus the borrow. Okay, so that's a high-level view of the data that we have, and we can discuss what the implications and sort of how we view this information. I have some interpretations of my own, but I'd like to open up to the floor. Are there things here that stand out? And are there pieces of information that you guys think are missing, or ways that you think are valuable to interpret this data, certainly towards actionable, actionable interpretations? My guess would be that we are looking primarily in the short term at the rise in Bitcoin price. But if one goes to sovereign.app and looks at the system's line of credit, this currently is the lowest line of credit, and it has about 240% collateralization. After that, you're almost at 300%. And there's something of an arms race between holders of lines of credit if they do not want to be redeemed against. Now, the awareness that redemptions can occur is encouraging users to try and maintain high collateralization ratios so that they are not among these lines of credit, which are, certainly this would be, if there was a redemption now, this would be the line of credit that would be redeemed against. But you don't want to be one of the lines of credit which has a higher likelihood of redemption. So I think it's a combination of this sort of red queen or treadmill competition between the various lines of credit, and more recently, over the course of the last week, an increase in the value of BTC.
Just a quick comment on that. Yeah, I think you're exactly right about every point you made there. But it's also interesting to me. I was just looking at Liquidity's total collateral ratio, and it's almost as high as ours is, even though they're not having the same problems with redemptions as we are. And so the distribution goes down all the way down pretty close to 110% for them. And basically what we've done is we've chopped the left half of the distribution off through redemptions. But overall, it's really not a whole lot higher than theirs, which actually surprised me.
Yeah, we've seen. I think that's been fairly consistent with Liquidity. We started out with a much lower collateralization ratio and a sort of much higher tolerance of risk for people who are taking out lines of credit early on. This may be in part due to people coming, getting a feel for the system, both with ourselves and with Liquidity. I also suspect that with Liquidity, there's a relative weighting towards sort of whales who have significant holdings. It would be interesting to see what the sort of distribution of value held in their lines of credit is as it compares to sovereign dollar and zero.
Yeah, I might be able to come up with that before the end of the call. I just looked, and their total collateral ratio is 244%. So like I said, that's not too far below ours. And I think maybe like last summer when we were first getting going, theirs was somewhere around 190 to 200. So theirs has gone up also. It's not just ours. So there are evidently more factors involved in that than just the redemption race that we're dealing with. And that probably has a lot to do with the rise in the price of both ETH and Bitcoin.
Okay. Are there additional comments or questions? I would say that there are two primary impacts. The first is that right now, and I think we're aware of this, zero is not appropriate for low collateral positions, and we continue to have this challenge of balancing supply and demand. In terms of providing additional warnings in the UI and that, I think that at some point, it would be probably better to provide material in the form of a blog post. There's only so much information we can load into the UI, and I think micromanaging the UI in that way is probably going to ultimately lead to clutter and more confusion. I think the system, even if you just go, if you look at the page I'm currently on, yeah, 3/4 of the page is devoted to showing the lines of credit as they in their order of redemption. So I think in terms of provision of information, it's there. The second upshot of this, and this is important, is it impacts the potential profitability of the liquidation or stability pool. Very high collateral ratios means that the likelihood of liquidations is low, which means that the stability pool is less likely in the near term to deliver returns besides the 5% reward that we are providing in the form of SOV. So I think that is that's maybe the most obvious near-term impact. Okay, so I think there's some value here in providing some additional context. There is currently within the community various efforts, and we also discussed this on the community call, and it was discussed in some of the forums over the last days, and particularly today. There was community chatter about various efforts around delivering additional demand to sovereign dollar. These include working to export sovereign dollars to other chains and DeFi platforms, having the incentive curves provide additional rewards to those who bring stablecoins in from basically imports. So I'm going to talk about it as importing and exporting. Importing external stablecoins, providing the opportunity for margin trading with the sovereign dollar to increase yields on sovereign dollar lending, which will drive additional demand in the lending pool. The 5% reward and communication around that on the stability pool, and efforts around potential partnerships and having sort of larger holders of stablecoins or treasuries of DeFi applications move part of their treasury into the sovereign dollar so that they have access to an uncensorable stablecoin. Most of those efforts rest on the ability to build credibility around sovereign dollar as maintaining its peg. And so we have this ongoing tension between providing comfort that lines of credit won't be redeemed against, and making sure that we maintain a very tight peg, or the tightest possible peg, around the sovereign dollar. One Digit has, on repeated calls, suggested that from a long-term perspective, for the holders of lines of credit, for the credibility of Zero and for the credibility of the sovereign dollar, maintaining and building a reputation and a commitment to keeping the peg very tight and therefore reducing the redemption fee is the way to go. A reduced redemption fee means that the ability for sovereign dollar to fall below its peg is very limited. And given the efforts that are currently being undertaken by a whole swath of members of the community, and the fact that I think we're starting to see some progress on them, I think there's an argument to be made that what we need to be investing in now is the commitment to the peg, and also perhaps making sure that that commitment is also longer term. And so there's the tension now between maintaining the redemption fee where it is or reducing it further to 0.5% and holding it there. And it's, just looking at the data, it's hard to make an assessment, but we are seeing some degree of balance between originations and redemptions and repayments. But in particular, what's important to us is the redemptions here. And so I put to you the question of should we consider reducing to 0.5% the redemption fee. One important aspect, I think it will take weeks or months for us to see all of these efforts, or the majority of these efforts, start to truly bear fruit. And so there's going to continue to be I would say, let's say the next 2-3 months, this tension is likely to remain. And even as we start to see them bear fruit, we're going to keep hitting higher and higher plateaus or higher and higher ceilings for a while, until the ratio of lines of credit to the potential imbalance becomes much less significant. And so the argument that I would make in favor of reducing the redemption fee is that we now have a period of several months to invest in making sure that the peg is extremely tight. And the argument that I would make against is, at the same time, we don't want to continue to see lines of credit even further embattled. And so this is the question I put to you.
I have a question, if I may.
Yes, please. Who's speaking?
This is T-Bone.
Hi, T-Bone.
Hi. Anyway, I guess I'm trying to figure out what is the difference, or what would be the difference, and I'm sure you guys have the answer, to redeeming from the dollar BTC, RBTC pool, as opposed to the collateralized Bitcoin. And if there is a difference in terms of cost, in terms of, like, it might be a higher fee, is there a possibility that we could subsidize some of that fee so that we don't have to cannibalize our members' BTC collateral?
I will attempt to answer, and if anyone would like to contribute to the answer, please do. My response would be as follows. There's two ways of moving from sovereign dollars to, let's say, some other asset. Let's call it Bitcoin, but through Bitcoin to any other. One is you swap sovereign dollar for something else. So, for example, in the AMM you would swap, or through Babelfish, and that in Babelfish it's liquidity dependent. Or what is always available is redemptions. Now, the primary mechanism that most users are using at the moment is they trade out of sovereign dollar. When they wish to trade out of sovereign dollar, they do it on the sovereign dollar BTC pool on the AMM. There is the price of sovereign dollar. There is the potential for slippage, and there is the fee. So those are the potential costs. If the price of sovereign dollar is lower, then that is subtracted from how much BTC they would get. Now, the challenge there is if we were to reduce that fee, it would also reduce the amount of earnings that the LPs in that pool were earning. It also wouldn't necessarily actually it would, and it would also impact the two other vectors. If the LPs are earning less, then there is a likelihood that the LPs will be less attracted to provide the depth of liquidity that we would like to see actually grow in that pool, and that would increase slippage, and as a result would also increase any differences in price. So there is the possibility to play around with the fees there, but in practice what we would like to see is a deepening of liquidity there, and the fee that is charged and paid primarily to the LPs is the primary, or is a primary way of delivering that. Right now the protocol takes about 15% of the fee. In fact, it might be exactly 15% of the fee, but is paid to the protocol, and that we could potentially cancel. I don't know how significant that would be. Overall, my sense is that our ability to push to make it cheaper to go through the AMM is currently quite limited.
Okay, thank you. I would like. Yeah, so I thought that, and my percentages may be different or wrong. I'm not sure, but I thought that the protocol got. I thought it was about 25% of the fee, the AMM fee, and even the stakers. I think the protocol is what the stakers get. If I'm correct, is that correct?
Yes, SOV stakers are earning the protocol fee.
Okay, so but I guess what my thoughts would be, is it possible to, and I know you said, well, it might be negligible, that we could, maybe until we find more demand, vectors or demand channels for dollar, that possibly we could give up, the stakers could give up their protocol fee to help. It's just thoughts. I mean, I'm just,
No, I think these are good thoughts. This is the kind of thinking we should have. Intuitively, look, the fee charged by the protocol is 5 basis points, or 0.05%. It is a relatively small component of the cost between slippage, price differential, and then LP fees. It represents, probably 1 or 2% of that. So I don't know that anyone would notice the difference.
So how long do we estimate? And I know they're estimates, and I know we don't have hard estimates, but do we have any kind of idea of when we're going to actually get a dollar trading pair on margin, and some of the other things that we talked about in previous meetings? Because I do think there's a lot of liquidity on the sidelines waiting for a lot of those things. If we can get the interest to the interest rate on the dollar lending pool up, I believe that there's probably a lot of liquidity out there waiting to, take some of this supply.
Yeah, so if I'm not mistaken, I think from the perspective of the dev team, they are basically ready to provide margin trading, or have already provided margin trading with sovereign dollar. The issue is, what do we do to drive that forward and make sure users are using it? I believe that One Digit right now is engaged in a study of the margin trading behavior on the protocol. I don't know, One Digit, if you have any insights to share on this yet.
Not really on that topic, no.
Okay. Do you have any other points which you think would be relevant that we should raise?
Well, I don't know what to do with this, but one thing I was thinking about is that I noticed that the repayment rate seems to be going up a little bit. And one thing that would discourage that would be if we drop, I mean, this is kind of working at cross purposes with ourselves, but as long as the peg is below 100%, that provides more incentive also for people to repay their loan. You know, once it gets to 100%, there's no particular reason to do that. And so there may be given that the repayment seems to be kind of kicking up right now, I'm a little bit inclined to just kind of leave things where it is, where the rates are right now, just to give people more opportunity to repay a loan rather than redeem, because it is a little bit of a discount to repay right now. So again, I do think we should aim for a fairly tight peg, but one of the factors in all this is if you look at the peg, it's just kind of all over the place in a way. But let's say by comparison to something like DI, which is, varies in very, very small amount. And that's because the markets that's involved with are much, much deeper. And so, anytime somebody makes a big trade on our AMM, it affects the peg, one way or the other. And so until we have much deeper markets, I don't think we're going to be able to keep the peg to, precise, like within, 0.1% of the correct, the target value. So we're going to have to live a little bit with more variation than that. And so I'm wondering if we're getting pretty close to as small as we can control, given the level of liquidity that we have. So that doesn't end with a recommendation per se, although I guess I slightly lean to just leaving it where it is at the moment and seeing how it plays out a little bit longer.
Yeah, I think you're absolutely right that the relatively shallow markets are going to mean, even if there was like a 0% redemption fee and a 0% origination fee, there would continue to be some degree of volatility around our peg. And that will diminish with depth of liquidity. I think you're totally right.
So it kind of appears that the consensus is that we need to increase demand for a dollar. I mean, but I guess we've been there, since the beginning of this the project. I think we all agree with that. I saw in some of the community channels, the Telegram, what have you, and I guess we're looking for ways or other protocols to collaborate with, such that we could get this additional demand or liquidity for a dollar. I just don't know that we can grow one way or the other without and continually tapping into people's collateral, especially if say after you're at 300%, you're talking about a third. So what is the incentive to to take on? And I realize that this particular product isn't for everyone. I get that, but that would still be some concern, that you constantly are concerned about being redeemed against, especially in this environment where BTC seems to be going up. People really don't want to get redeemed against. So, I mean, it's just a conundrum. And I understand that you guys have the same conundrum. You know, I'm not saying that you don't. I realize that you do. Um, and like I said, just thoughts, you know, I'm thinking out loud, and hopefully somebody can, you know, brainstorm or come up with some additional, you know, um, ways to move forward.
So, what you describe as a conundrum, right? I think it's a chicken and egg problem that all two-sided markets have. And the way that we unlock growth is by focusing on the hard side of the market. The hard side of the market right now is sovereign dollar demand. And that's something we can make progress on. There's a number of efforts. I think we're seeing progress on them. It's not going to be a one and done, but with each additional source of demand, probably initially small, we will build momentum, we will build credibility, and we will build knowledge around the opportunities out there. So, to my mind, right now, I would go so far as to say we can completely ignore the attempts to grow the zero borrow side of the market, and should be focusing on the demand side of the market, because we know that we can grow the borrow side of the market. So we have to focus where things are hard, because the easy will come by itself. I think we can definitely take a poll. Correct. It would be great if those of you who are voting could also, even just in one line, explain your reasoning. I think that would be helpful for everyone to see. And also, we have a fairly deadlocked vote right now.
Gentlemen, I'm sorry, I had to step away for a second. What is it that we're voting on, and what, you know, could someone explain it to me quickly, please?
Yes, can you see the chat that is associated with this call? It's on the upper.
I'm sorry, I was on my phone, but I can see the chat or anything, but I don't want to cause any, you know, undue noise and everything else. So, what, I appreciate it.
Well, yeah, so I'm not sure how many people have voted, because it looks like some people have voted twice. Preferable to vote just on one side. And if you can provide your reasoning, that would be helpful. In any event, this is not where we'll make the decision. We'll open the conversation up on the forum and have a deeper discussion there. Written, I think conversation tends to be more formal and tends to lead to more rational conclusions. But it's good to provide these conversations for context, and I also think it helps form, if there's an opportunity to form a consensus opinion, which I don't think we currently have. Okay, I think we've had enough time for the vote. Are there any additional points or topics that anyone would like to raise? I think actually, look, Lactarius has made a third suggestion. Lactarius, would you like to make the argument, the case for your suggestion? Okay. Would anyone like to comment further? In that case, I think that would be an excellent idea. So, Inglandi, I'm handing it over to you to close out the call. Thanks everyone for participating and for giving me and all of us an opportunity to talk. Stay sovereign.